Okay. So read about synergy, read about due diligence, reason for merger and acquisition. What are the methods of financing acquisition, M&A? So you need to know them, due diligence. All right. So our focus will be on business valuation. So let's go straight to business valuation. That's where we have major work to do. Okay. That's where we have major work to do. Let me see. Almost there. Okay. Without wasting more time, what do you understand by valuation? Business valuation represents the process of determining the economic worth of a business or of a company's share. Whenever you want to determine the value of a company or the value of a company's share, in that case, you are trying to determine the valuation of the company. All right. So the process of doing that, the process of determining the market value of a company or of a company's share is what is known as a valuation. Of course, valuation are being carried out for different purposes, including merger and acquisition. When two or more companies are coming together to become one, or a company is acquiring controlling interest in another company. So there will be a need to value the individual company in order to determine the current worth, okay, of the business before the business combination will take place. That's one. Then two, your valuation are being done when for estate and tax purposes. Okay, when the company, when somebody dies and then the individual bequeaths some properties or estates to some beneficiaries, so there will be need to determine the worth of the estates for in order to know how much to allocate to each beneficiaries, and not only that, to determine the amounts that will be attributable to tax liability. So you need to value the estate or the property. Then another one is that valuation are being carried out for the purpose of litigation. Okay, when there's a dispute, when there's a litigation between parties, and of course, when you say litigation, that means court is involved. So as a result, the court may request that we determine the value of the property in disputes for the purpose of determining the claim that either of the party will settle the other party. All right. Again, valuation is being carried out for the purpose of stock exchange listing. Okay, when a company wants to raise capital, so you need to determine the worth of the business before you put your shares to the public, okay, for subscription. Again, whenever a company wants to request for loan facility, okay, when you also need to your lender or your prospective lender may want to know, okay, your worth for the purpose of determining whether you have the capacity to pay the loan that you want to borrow. So of course, whenever you also value a company when there's shareholder or partnership disputes, okay? But these are just some of the reasons for valuation. So you have it in your material, just go through them. But what is important is that valuation is a very critical analysis that requires the expertise of professionals that are well endowed with requisites, technical know-how, and appropriate qualification. In most cases, valuation, merger and acquisition are being done in secrecy before it become public information, because of the fact that if everybody is aware, if all the participants, if all the members of a company or um, of the combining businesses are aware of the transaction, there is tendency that the transaction may fail. Okay, because you can't see if somebody is holding a cutlass and want to cut your neck, certainly you have to find a way of preventing it. So the same way, because there is no how, there will be business combination. If two companies are merging together or a company is acquiring another company, so there is no way there will be no job. Okay, so and then again, the union may go against it, so they may protest against the transaction, so which may make it to fail as a result. It's usually done in secrecy, all right, until everything has been finalized before it now become a public information. But that's a story for another day. So our focus tonight will be on methods of valuation. Okay, how do you value a business? Majorly, let me stop sharing this and move to so that I can explain better. Uh, Majorly, there are three methods of valuation. Number one, okay, methods of valuation. So there are three methods of valuation. Number one is asset-based. There are so many methods. There are plethora methods of valuation, but some of them can be grouped technically into three. One is asset-based. Okay, asset-based approach. Two, income-based approach. Then we have three, discounted cash flow based approach. Okay, so these are the three major methods of valuation. So each of them has other techniques. Okay, so let's talk about asset-based approach. Assets-based approach of valuation. Okay, yeah, using asset-based approach, valuation is done taking into consideration the net assets of a company. And you know, net asset is the difference between total asset and the total liability. So when valuing a business, the net assets is that over here. So I was trying to say, using the book value basis, valuation is done taking total tangible assets and the total liability of the company. Okay, using the book value basis, you are expected to take the total tangible asset of the company's assets. Okay, the total tangible assets, you less total liability. So which means that the non-tangible or intangible assets like goodwill, copyrights, franchise, um, patent rights are ignored except they have market value. Okay, so whenever you want to value a company using book value basis, you are supposed to ignore any assets like goodwill, right, franchise, trademark. So you ignore it. But if they have a value, then you have to include it. Okay, so majorly using book value, the value of the business will be determined as the net assets. Okay, the value of the business is determined as the net assets. So I now say that the net assets will represent the total tangible assets minus total liability. So that will give you the value of the business. Okay? So the value of the business, that's what you need to do. So whenever you see goodwill in a question or any of those intangibles, please ignore it. So that is that. Of course, the book value of asset-based approach is just a guideline. It's just a guide to determine the minimum amount to pay for the value of the business or to pay for the value of the business. So it should be used in conjunction with other techniques or with other methods of valuation, because asset-based approach is not sufficient to determine the economic worth of a business, because it relies heavily on the historical cost of the company's assets. Then the other method, other technique under asset-based approach is replacements. We have replacements, value basis. Number 3, we also have realizable value basis. Number 4, there is breakup or liquidation basis. So these are other methods of valuation under asset-based approach. Of course, the replacements, realizable, and breakup basis are valued similar to book value basis, except that the book value are replaced with the basis. All right. So the same way you calculate net assets using book value is the same net asset you are going to calculate using the replacement value basis. So I will use a question to explain all of this when we get there. But for now, just note that it's the same thing. The same way you are going to calculate your net assets using book value is the same way you are going to do for the remaining 3. So what I'm trying to say in essence is that when you are determining the instead of using the book value, you are going to use replacement value, because examiner will give to you the replacement value. Okay, they are going to be given the value of the assets under replacements, realizable, and breakup. So you are going to be given the value of individual assets. Therefore, what you need to do is to replace the book value, the historical value, the cost of the asset, or realizable cost of the asset, or liquidation cost of the asset. So that's basically what you need to do as far as asset-based approach is concerned. So the second one is income-based approach. Okay, income-based approach. So under the income-based approach, there are three categories. There are three elements. We have price earning ratio, price earnings ratio. Then we have dividend yield basis. Then we have earnings yield basis. So these are the three elements that make up the income-based approach. So what do you mean by price earning ratio? The price earning ratio represents the ratio of share price to earnings. Okay, you know, in investors ratio or shareholders ratio, when you talk about price earning ratio, when you want to determine price earning ratio, we say share price divided by earnings per share. Okay, so that's why we say price earning ratio is the ratio of share price to earnings per share. So this share price is the value of the business. Therefore, when you want to determine the value of the business using price earning ratio, all you need to do in this formula is to cross multiply. I would then say valuation using ratio is simply the price earning ratio multiplied by earnings. So whenever you want to determine the value of a business, you use the price earning ratio. It is determined as price earning ratio multiplied by earnings. Okay, that is the major problem with earnings is the fact that price earning ratio is only available for companies that have the history of profitability. It is only a company that makes profits that usually use, that you can use the price earning ratio to value. Okay, any company that is making loss, a loss-making company cannot use price earning ratio to determine the value of a business. All right, because it has to be your earnings, your profit after tax. Okay, now the price earning ratio is only available for a quoted company, which means that any unquoted company does not have an unquoted company does not have price earning ratio. So, which makes it very difficult to a large extent to value an unlisted company using price earning ratio. So under this situation, the most important thing to do whenever you want to value, whenever there is need to value an unquoted company, a limited liability company, so the most important thing to do is to borrow the price earning ratio of a quoted comparable company operating in the same industry. All right. So you adjust the price earning ratio of that listed company ratio of 10 and 50 to account for the risk inherent in a quoted company. So what I'm trying to say in essence is that when you want to value a limited liability company, so it will be difficult to use price earning ratio to value such a company because a limited liability company does not have price earning ratio. It is only a quoted company, a listed company that has price earning ratio. Therefore, whenever you want to value an unquoted company, we are supposed to borrow the price earning ratio of a comparable listed company, okay, that is operating in the same industry with the unquoted company. So once you borrow the price earning ratio of that listed company, you need to adjust the ratio downwardly between the ratio of 10 and 50. Okay, so you adjust the price earning ratio of the quoted company between the ratio of 10 and 50. In this case, if it's not specific as to the level of adjustment, the level of adjustment that you should make means that if 10%, other may assume 15%. So whatever the number of, the percentage you are going to assume for the risk inherent in the unquoted company uh, must be as per the percentage of the adjustments that you have done. Okay, so what I'm trying to say in essence is that so to value a limited life PE ratio, PE ratio of a listed company. Okay, PE ratio of a listed company. And say, for example, the PE ratio of the listed company is about 10. Okay, the PE ratio is 10. So in this case, you are not going to use the entire 10 to multiply the earnings of the company. Rather, you are supposed to calculate the adjusted price earning ratio. So in this case, to get the adjusted price earning ratio, it will depend the percentage of perceived risk associated with an unquoted company. If I think that the risk associated with this company would be like 15%, that means I'm supposed to account for 85% of the price level of the quoted company. In this case, I will just say 85%. This ratio that I'm going to use to value the business is 8.5. So that is what you need to do. If you think the risk associated with an unquoted company is 20%, it means that you are supposed to account for 80% of the price earning ratio. If your perceived risk on the list on an unlisted company is 30%, that means you are supposed to account for 70%. But the bottom line is that whatever the percentage that you have adjusted for risk purposes, then you need to state your assumption. Okay, you need to state your assumption so that you let the examiner know your position. Once you have adjusted the price earning ratio, then you come and put it there. Then, of course, there will always be an adjustment on your earnings because examiner cannot just give to you income statement of the company, just go in there and pick a profit after tax. No, it doesn't work like that. So majorly under valuation, there will be adjustment to be made to the earnings. So all you need to do is to go and calculate revised earning or adjusted earnings. So once you have done your working under the earnings, then you now multiply with the adjusted PE ratio if the company is not quoted. So, and that is that. That is that. So this is the formula for calculating the value of a business using price earning ratio. So the next one is dividend yield basis. Dividend yield basis. Okay. Is the ratio of dividend to share price. Just like we did when we had cost of capital, dividend yield is the same thing as cost of equity. So dividend yield is calculated as the ratio of dividend to share price. This is what I'm saying. Dividend yield is calculated as dividend divided by share price. Whether you call it SDIV share price or whatever, it's the same thing. So divided by, multiply by 100. So at times, examiner may not give it to you, the dividend yield. So you may be the one to calculate it. So this is just a reminder. We have done this previously. So to get your dividend yield is dividend divided by share price. That is, dividend yield is the same thing. Okay, dividend yield. Okay, dividend yield is equal to cost of equity. Okay, it's the same thing as cost of equity. Whether you denote it as KE or you denote it as R, however you want to do it, is the same thing. All right then, so if you now want to value a business using dividend yield basis, all you need to do is to just cross multiply from this formula, just cross multiply. You want to make the share price, you want to make the denominator the subject of the formula. In that case, valuation using dividend yield will represent the present value of future dividend, okay? The present value of future dividend payments, okay? Discounted at the dividend yield or cost of equity of the company. I will take it again. The value of a business using dividend yield represents the present value of future dividend payments discounted at the dividend yield or cost of equity of the company. So if I want to determine the market value of the company, it's simply the ratio of dividend, okay, the ratio of dividend to dividend yield or cost of equity. The dividend yield denoted as R. Okay, so this is how to calculate the market value of a company if you are using dividend yield basis. This formula is used where there is no growth, where dividend will remain constant, where dividend will remain constant. Okay, so you use this formula where dividend is constant. However, where dividend will grow, then the market value will be computed as dividend multiplied by 1 plus the growth rate, dividend yield minus the growth rate. So this formula is used where there is growth. In dividend payments. So whenever there's growth, you are given growth rate for dividend, then this is the formula you are expected to use to calculate the market value, okay? To calculate the market value of the company. So that is that. So using dividend yield basis, this is how to calculate the value of the business, okay? Then the next one is earnings yield. Earnings yield basis. The earnings yield basis, when you talk about earnings yield is the ratio of earning to the ratio of earnings to share price. The same way you calculate dividend yield is the same way you are going to calculate earnings yield, except that instead of using dividend, you are going to use earnings. Therefore, the earnings yield earnings yield is computed as the ratio of earnings to share price multiplied by 100 over 1. So if you now want to determine the value of a company using any sheet, all you need to is the market value of a company using earnings yield will then be the present value of future earnings discounted at the rate of return of the company, okay? Discounted at the rate of return of the company. So where there is no growth, the market value of the companies will then be equal to earnings divided by earnings yield, or denoted as R. Okay, so you use this formula where there is no growth, where earnings is constant, where there is no growth in earnings. That's when you use that formula. But where earnings will grow, the market value will be computed as earnings, okay, multiplied by 1 plus the growth rates divided by earnings yield, which is R. So you use this formula, of course, minus J. Use this formula where there's growth in earnings, okay? So that is that. It's dividend yield basis that is common and price earning ratio. It's been a while examiner tested valuation using earnings yield. Okay, so that's that. So these are the three ways of valuing a business using income-based approach. So the first one is price earning ratio. Okay, the first one is price earning ratio, followed by earnings dividend yield basis, and then the third one is earnings yield. Okay, earnings yield. This is B. Okay, so finally, let's talk about the most sophisticated method of valuation, which is discounted cash flow based approach. Let's talk about discounted cash flow based approach. Discounted cash flow based approach. So the discounted cash flow based approach is a method of valuation that relies heavily on the use of free cash flow to value a business. So for this purpose, valuation will be carried out depending on the scenarios of the question, okay? Valuation will be carried out depending on the scenario or depending on the valuation scenario. So let's talk about valuation scenario. Valuation scenarios. Number one, scenario one. The scenario one, let me put it down. This occurs, or this is a situation, this is a situation whereby business risk and financial risk or debt equity proportion are expected, debt equity proportion are expected to change as a result of the business combination. Okay. So when this happens, valuations should be carried out. Okay, valuation should be carried out using the WACC of the combined businesses. WACC of the combined businesses to discount the free cash flow. Okay, so that's what you need to do. Under scenario 1, business risk is changing, financial risk will also change. As a result, you have to calculate free cash flow first, then you go ahead and calculate the WACC of the combined businesses to discount the free cash flow. So you add up all your present value, whatever you have will represent the corporate value. Now, as far as scenario 1 is concerned, there are procedures you are supposed to follow. Okay, there are procedures you are supposed to follow. Under scenario 1, the following procedures should be considered. Okay. Step 1, you need to calculate free cash flow to the firm. So calculate free cash flow to the firm. Then step 2, calculate WACC of the combined businesses. This is calculated. The WACC of the combined businesses is calculated. This is computed. Same as WACOCA. The same way we calculated WACOCA under cost of capital is the same way you are going to calculate the WACOB. All right? So same as WACOCA. By carrying out the following procedure. So let me refresh your memory on what we did under WACOCA. So this is a revision for you. To calculate the WACOB, steps. Number 1, identify the beta of individual company. Okay? You know, two businesses are coming together. So you need to know what is the beta of company A, what is the beta of company B. So once you have found it, you have identified it from the question, then that's step 1. Then step 2, you ungear the beta. If it is geared, you already know the formula to ungear. So if you are given dead beta, you know the formula to use the Stedham formula. If you are told that dead beta is risk-free, then you use the singular one. So I don't need to write down the formula for you again to save time. Then step 3, you calculate market value of equity and debt of each company. Then step 4, again, you know how to calculate market value of equity and debt, the same way we did under cost of capital. Market value of equity is number of shares multiplied by ex-div share price. So market value of debt is nominal value multiplied by exchange price divided by 100. You know all those stuff. It's the same thing. Then step 4, a weighted average Estimate the weighted average. Average asset beta. Or combine asset beta. Combine asset beta. How do you calculate combined asset beta? You remember, we said combined asset beta is computed as the beta total market value of this first company divided by total market value of the first company and the beta asset of the second company multiplied by total market value of equity and debt of the second company divided by total market value of the first and second company. So you remember this big formula, okay? The big for nothing formula. So that's the formula for calculating the beta asset of the combined company, okay? Combined companies. Then step 5, you need to regear. You regear to incorporate financial risk. Again, the formula you are going to use to regear will depend on whether debt beta is given or debt beta is risk-free. Then step 6, you calculate cost of equity using capping. Okay, using capping. Then step 7, you compute WACOB. Same formula you use to calculate WAC. That is WACOB denoted as KW. So it's computed as KW equal to equity value divided by equity plus debt, cost of equity plus debt value, equity plus debt, after tax, cost of debt. So that's the formula. These are the procedures you are supposed to carry out whenever you want to calculate WACOB. So first thing first, you calculate your free cash flow to the firm. Then you put it to calculating the weighted average cost of capital of the combined activity. Then, of course, let me use Roman figure. Then step 3. Step 3 will then be to calculate present value by discounting the free cash flow to the firm using WACOB. Okay. Then step 4, calculate the total present value. Calculate the total present value, including the PV to infinity. Ordinarily, when you want to calculate the corporate value, your total present value is the same thing as corporate value. So for you to get your corporate value for the first stage, for the initial stage of the transaction, it could be for the next 5 years or 3 years or 4 years, whatever. That's the planning stage. Then you now calculate the present value to perpetuity, okay? Because you are merging with a company that you are going to stay together for life. You are acquiring controlling interest in another company with the hope that your interest will continue for the foreseeable future. Therefore, for the short-term period, for the initial stage, for the planning period, maybe for about 4 years, 5 years, whatever the year has given. So you need to calculate present value for that. Then you now calculate the present value to infinity. So in this case, whenever you want to calculate present value to infinity, then of course, depending on whether, okay, I will give you the formula when I finish all the scenarios. Understand what I'm trying to communicate. Okay, then, so these are the procedures you need to determine, you need to carry out whenever you want to value a business using where business and financial risk are expected to change as a result of the business combination. Then number B, scenario 2. Under scenario 2, this occurs This occurs where business risk will not change, but financial risk will change. Financial risk or debt equity proportion. Okay, debt equity proportion will change as a result of the business combination. Okay, so business risk will remain constant, but financial risk will change. I will explain to you what business risk and financial risk, of course, you already know, but I will remind you later on. But for now, let's maintain this. Okay, so whenever business risk will not change, but financial risk will change as a result of the transaction, then in that case, valuation should be done. In this case, valuation should be carried out using the adjusted present value. So the same thing you normally do under adjusted present value. So it's what you are going to do here. What are the procedures? Let me just show you the procedures. I'll be very happy if I can solve a minimum of 2 illustrations tonight. You have to bear with me. Okay, so there are 4 procedures. The first procedure is to calculate base case NPV. Calculate base case NPV. How do you calculate base case NPV? The first thing under valuation, the first thing you are going to do is to compute free cash flow to equity, because we are told that just say calculate free cash flow. We'll come back to that one later. We'll explain it. So you calculate free cash flow. Now, the bottom line is that after calculating you don't use the relevant cash flow under valuation. Your focus is on free cash flow to the firm. So after this, you need to discount the free cash flow using the cost of equity on gear. Therefore, you calculate cost of equity on gear. Okay, KEU. Remember, I told you whenever you want to calculate cost of equity on gear, there are three different formulas that you can use depending on whether you are given a debitor. So where debitor is given, where beta is given, I said there are three stages you are going to carry out. The first stage is to identify the beta. Step 2, you ungear the beta if it is geared. Then step 3, we calculate cost of equity ungeared. Calculate capping. Calculate cost of equity ungeared using capping. Okay? So these are the three procedures you are supposed to carry out whenever you want to calculate cost of equity ungeared where beta is given. Okay, where beta is given. Then where cost of equity is given. Okay, where cost of equity is given. Where cost of equity is given. So where you are given cost of equity, then cost of equity on gear will be computed using Miller and Modigliani formula. So using Miller and Modigliani formula, cost of equity of a gear is equal to cost of equity on gear plus cost of equity on gear minus cost of debt multiplied by debt value into 1 minus tax divided by equity value. So this is the formula for calculating cost of equity using Miller and Modigliani formula. All right. Then the third formula I provided for you is where WACC of the companies is given. Okay, where WACC is given, then in that case, you need to calculate WACC of a gear. So WACC of a gear is calculated as WACC of a gear multiplied by 1 minus debt value multiplied by tax divided by equity value plus debt value. So this is the formula for calculating WACC of on gear. WACC of a gear will be given. What you are looking for is WACC of on gear. Therefore, WACC of on gear is the same thing as cost of equity on gear. So these are the three different formulas I gave to you when I was explaining APV as to how to calculate cost of equity on gear. So now that you have calculated the cost of equity on gear, let me use numbers. This is number 1 step. Step 2, now that you have calculated cost of equity on gear, then you then move to step 3. By discounting the free cash flow using the cost of equity on gear. Okay? Then step 4. Step 4, calculate base case NPV. Calculate base case NPV. So the base case NPV will then represent the total present value minus purchase consideration. Purchase consideration is just like initial outlay. So the purchase consideration is the amount the predator, the targeting company will pay to the target company. Okay. All right. So that is that. So once you are done with calculating the base case NPV, the next thing you need to do, which is number B now, is to calculate the present value of financing effect cash flow. Okay. Calculate present value of financing effects cash flow. You already know the procedures. You go to the question, you calculate, whatever it is, put it there. Okay? You calculate PV of net subsidy, if any, put it there. You calculate PV of tax saved on interest, put it there. Add everything together. Your APV, your present value of financing will either be positive or negative. So this is PV of financing effects. Okay. So you remember all of this. We have done it under adjusted present value. So step 3 now. Step 3, calculate adjusted present value. And you know that APV is equal to base case NPV plus minus present value of financing effects. Okay, financing effect cash flow. So that is that. So these are the ways in which you can calculate the value of a business using adjusted present value. I said using adjusted present value, if the business risk of the company is not changing, but financial risk will change as a result of the business combination, then the most appropriate method to value the business is the adjusted present value. So the last area we are going to touch is scenario number 3. Scenario number 3. Let me check. Did I put A? Okay. So scenario number 3. Okay. I'll be very happy if I can solve at least two illustrations tonight. Okay. Scenario number 3. This arises when or where business and financial risk will not change or are expected to remain constant, will not change as a result of the business combination. Under this situation, the business should be valued. The combined business should be valued using the current weighted average cost of capital of the businesses, or using the WACC of the combined businesses. Using the WACC of the businesses, using the current WACC of the businesses after, or let me put it this way, or the post-merger or acquisition, post-merger or acquisition weighted average cost of capital. All right. So under scenario 3, the business risk and financial risk will not change. Okay. For scenario 2, business risk and financial risk, business risk will not change. Will not change, but financial risk will change. Okay. That's scenario 2. Scenario 1, business risk and financial risk will change. So watch out for all of that. One of the scenarios will be given to you if examiner wants you to use a cash flow basis to value the business. Okay. So just know what to do at the right time. Yeah, for the scenario 3, like I said, once the business and financial risk will remain constant, then in that case, all you need to do is to calculate the free cash flow. What are the procedures? Let me just give to you. Procedures, what you need to do. Step 1, calculate free cash flow. Step 2, calculate the current weighted average cost of capital using traditional method. Okay? Calculate the current weighted average cost of capital using traditional method. Then step 3, compute total present value for the initial stage. All right. So the total present value will represent the market value of the business. It's as simple as that. So that's all you need to do. I've explained all the concepts in determining the value of a business. These are all the procedures. I've taken my time to explain the procedures one after the other, what you need to do. So the next thing we want to do now is to have illustration. But before we have illustration, let me explain to you, let me remind you again what we did under project-specific cost of capital in relation to business and financial risk. You know, in the scenarios that I just mentioned, the 3 scenarios I just mentioned to you, I talked about business risk and financial risk. You will recall that when we had project-specific cost of capital, I mentioned to you that business risk is the risk associated with the industry where a company operates. Therefore, I also mentioned that financial risk is a risk arising from debt financing. When a company finances operation with debt capital, it could be bond, debenture, loan notes, or bank loans. So when that happens, the company will be exposed to financial risk. Now, as far as valuation is concerned, when you want to use the discounted cash flow method to value a business or to determine the economic worth of a company's share, the scenario will be painted, the question will be given to you scenario on scenario basis. So, and that was why I explained each of available scenario that may occur or that you may likely see on that day. So I said business risk is the risk associated with the industry where a company operates. So when you look at a question, if your examiner wants you to use free cash flow, you are going to see it in the question. It is very implied. Okay, it is very implied in the question to you know that you are supposed to use free cash flow. Now, using discounted cash flow method to value a business. So you go in straight to the question. Identify if business risk is changing. Provided business risk will change, how do you determine that business risk will change? If you are told in the question that the two businesses are in different industries, say for example, company A is a manufacturing company, company B is into real estate. So the two of them are not the same, they are not in the same industry. As a result, business risk will change. So if you are not told whether, if there's no indication in the question whether the two companies are in different industries, then in that case, once you are given different asset beta, it means that business risk will change. Let me explain further. Okay. So I said business risk is the risk, okay, is the risk associated with the industry where a company operates. Okay. Therefore, business risk will change. Business risk will change if the two combined businesses or companies are in a different industry. Okay. For example, one company is into real estate, the other one is oil and gas, and they are coming together to become one. As a result, business will change. Okay. So like I said, business will change if the two combined businesses are in the same, are in different, in a difference, not in the in a different industry, or in a different industry, or where different asset beta are given for the two companies. You know, asset beta measures business risk. Okay, then. So once you are given different asset beta for each company, it means that they are in different industry. As a result, business risk will change. But if you are given the same asset beta, it means that business risk will not change. So watch out. Watch out. Then the financial risk. As per the financial risk is the risk arising from debt financing. That is, when a company finances is operation with debts, such as bonds, debenture, loan notes, or bank loan. So when this happens, of course, that is financial risk. So financial risk will change. Let me use a paragraph. Financial risk will change if the transaction will result in debt payments or the debt equity proportion or the debt equity ratio will change after the business combination. So once you are told that as a result of the business combination, one of the company will pay debt, especially the predator, if the targeting company will pay debt, okay? As a result of the business combination, it means that the company will be exposed to financial risk. Or if you are not told that, the examiner can also tell you that after the business combination or after the merger or after the acquisition, the debt equity ratio will alter to a specific percentage. So if you are given debt equity ratio after the business combination, it means that financial risk will change. So that is how to identify whether business or financial risk will change. So that's an additional information for you. So at this point, let's have an illustration. I'm done with all the relevant explanation. Yes, one more thing I need to explain to you. Like I was trying to explain to you earlier on when we started the first scenario, I mentioned that you need to calculate present value for the first phase of the business combination. The first phase is the planning phase. It could be for year 3 or year 4 or year 5. So you need to calculate present value depending on the number of years given to you. Then that is one, because the business is for continuity. The business will continue for the foreseeable future. So after the business combination, you need to determine the present value to perpetuity, to infinity. In this case, how do you then calculate present value to perpetuity? Let me show you. Calculating present value to perpetuity, that is infinity. Now, the present value to perpetuity will be calculated as follows. This will be calculated depending on whether the free cash flow will be constant, to perpetuity or will grow. Okay. Number A, if the free cash of the base year if the free cash flow of the base year That's the free cash flow of the base year. If the free cash flow of the base year will remain constant, so infinity, then in that case, the as the free cash flow of the base year divided by cost of capital, weighted average cost of capital, depending on the scenario, okay? Whether it is cost of equity you want to use or cost of capital. But in any case, divided by the weighted average cost of capital. Let's use let's just use R. Then multiply by the discount factor of the base year. If the free cash flow, if the free cash flow of the base year, okay, will grow, if the free cash flow of the base year will grow, then the present value to infinity will be computed as the free cash flow plus the growth rates divided by cost of capital minus the growth rates multiplied by the discount factor of the base year. So that is the formula that you are going to use to calculate the second stage of your present value. So where FCFFBA is equal to the free cash flow of the base year. Then, of course, G equal to the growth rate, R equal to cost of capital. Average cost of capital. Then DFBY equal to discount factor of the base year. Okay, what else? I think that's it. I've defined the variables for you. So that's what you need to do. So at this point, please, let's have illustration. We have about an hour left. So let me know, before we have illustration, let me know if you have any question for me. If there is none, then let's have illustration. I will stop sharing this and move to the notes. Okay. So go to your material, you read more in details or what I've been saying since. Yes, because of the current happening in the Nigerian banking sector. So let's have this illustration number 1. Okay. You never can tell. Let's have this illustration number 1. I need somebody to read for us. Who will help us to read? Yes.
Michelin, let me read.
Thank you, Jide.
Michelin Bank PLC is a commercial bank incorporated in Nigeria in the early 80s. The head office of the bank is situated in Lagos, and it has a network of branches in all the states of the Federation. The objectives of Michelin Bank PLC are maximization of shareholders' wealth and provision of efficient retail and corporate banking services to its individual and corporate customers. These have been achieved over the past years. Recently, the federal government, through the Central Bank of Nigeria, revised the minimum capital of banks. This condition was to be met by all banks 31 December 2000, latest 31st December 2005. This forced all the banks to offer to members of the public their ordinary shares for subscription. Michelin Bank PLC, in line with this directive, offered its shares to the public. However, it only succeeded in increasing its capital base substantially, although this still falls below the required amount. The only option that is open to Michelin Bank PLC, if it wants to remain in business, is to amalgamate with another bank with good track record. The bank which comes to mind is Dunlop Bank PLC, which incidentally managed to increase its capital base to 10 billion naira. The board of Michelin Bank PLC is considering making an offer to Dunlop Bank PLC. The offer is to take the form of merger on a share-for-share exchange basis. The new bank to be formed is to be called Saya Bank PLC. Extracts from the most recent accounts of the two banks are given below. All figures assume correct net asset. Okay. Both companies retain the same proportion of profit each year and are expected to do so in the future. While Michelin Bank's dividends are expected to grow by 12%, those of Dunlop Bank are expected to grow by 4% per annum. After the merger, i.e., in 1 year's time, Tara Bank PLC will retain 60% of its earnings and post-merger dividends growth rate is expected to be 10%. The dividends of both companies have been paid. The required rate of return of the ordinary shareholders of Michelin Bank PLC is 15%, and that of Dunlop Bank is 12%. After merger, this will alter to 14%. Required. What is the required minimum capital for Nigerian banks under the current dispensation? What is the type of integration anticipated by Michelin Bank PLC called?
Number C.
See, if the merger is to take place immediately, calculate 1, market value of the two banks before merger. 2, maximum price Michelin Bank PLC will pay Dunlop Bank PLC. Thank you.
Thank you, Jide. That is the question. It's good for you to have idea on how to treat this particular question. The reason being that you will agree with me, currently there is a recapitalization exercise going on within the banking industry in Nigeria. So, of course, the capitalization threshold has increased with what it used to be with what it is currently to a new percent or a new cap. So as a result, almost all the banks now are out there raising the capital to ensure that they meet up with the due dates for as required by the Apex Bank, which is the CBN. However, this particular question was tested when the current capital base of banks were given. Okay, so another thing is playing out right now. So you never can tell where examiner will come out to you. And that's why it is important. Let's have an idea on how to at least to treat this. And not only that, you must be familiar with the happenings in the business environment, especially the new threshold that have been given to each bank to pay For example, there are three categories of Nigerian banks. We have commercial, we have merchants, and then we also have non-interest banks. So you must know the threshold for each of them. Under the commercial, you have international banks. You have international, you have national, you also have regional. Each of them, they have their own minimum capital base, 500, 200, 20, whatever, all of that. Again, if my memory serves me well, maybe tomorrow I will just share with you so that you have idea, you can, as a refresher. Okay, but that notwithstanding, to solve this particular question, number A, you are asked what is the required minimum capital for Nigeria banks under the current dispensation? As at the time, currently, the minimum capital base for Nigerian banks is 25 billion naira. That is the current one. So this 25 billion has been increased depending on whether is a commercial, merchant, or non-interest bank, and all of that. It's a different. That's what I was saying, that you should know the new dispensation as communicated by the CBN effective March 26 or thereabout 2024. Okay, so you must know what the new minimum capital requirement is all about. So to answer this particular one, the current minimum capital for Nigerian banks is 25 billion naira. Okay, it's 25 billion naira. All right. Then number B, what is the type of integration anticipated by Michelin Bank PLC code? So you notice that Michelin and Dunlop banks, they are in the same industry. Okay, they are in the same industry. Therefore, when two comparable companies operating in the same industry with similar size merging together, that is what is called horizontal integration or horizontal merger. Okay, this is horizontal integration. Okay, integration. That is the answer for that. Then number C, if the merger is to take place immediately, calculate the market value of the two companies before merger. Then 2, maximum price Michelin Bank with PLC will pay to Dunlop Bank PLC. So you want to determine market value. Pay attention. To calculate market value, you need to ask yourself, how are you going to calculate the market value before the merger? Michelin and Dunlop banks are merging together to become Tire Bank PLC. So examiner is now asking you to determine the pre-merger market value. So the pre-merger market value will be computed depending on the information you have in the. You need to ask yourself, which method are you going to use to value the business? Are you using asset-based approach? Are you using income-based approach? Or you want to use discounted cash flow-based approach to value the business combination? Of course, examiner may not tell you to use any method, but it will be implied. The direction of the question will tell you which method you are expected to use. When you look at the scenario as written in the question, you will notice that examiner was emphasizing on dividend. So you can see in this particular question, you have information on dividend, okay? You have information on dividend. And then the growth rate given to you in the question, examiner mentioned that while Michelin Bank's dividend are expected to grow by 12%, those of Dunlop Bank are expected to grow by 4%. As you can see, examiner is showing you the direction that you should follow. Not only that, examiner also mentioned that after the merger, Tire Bank PLC will retain 60% of its earning and post-merger dividend growth rates is expected to be 10%. So examiner has also given to you the growth rate of the that I'm supposed to use dividend yield, okay, to value the business. You are expected to use dividend yield to value the business. So if that is the case, I will stop sharing this and move to the working note so that quickly we can solve this and move to the next one. Okay. Page 1, page 2, page 3, page 4. Okay, still okay. Let me continue. All right, solution to illustration 1. The name of the predator, the acquiring, the company that is making the initiative is Michelin, because it's Michelin that wants to merge with Dunlop. Number C, Roman figure 1. We have done A and B. Let's move to C, Roman figure 1. Examiner is asking you to calculate pre-merger market value. So I would then say calculating pre-merger market value. So we have identified from the question that we are using dividend valuation model. Sorry, we are using the dividend yield basis to value the business combination. In that case, so the market using dividend yield, let me just to help you further. Since information on dividend is given in the question, dividend yield basis will be used to value the business. Okay, so this is shown as follows. I would then say using dividend yield basis, market value will be computed as, and then again, in this question, examiner has told us that dividend will grow. So market value will be computed as dividend multiplied by 1 plus the growth rate divided by dividend yield. Okay, divided by dividend yield. Okay, minus the growth rates. So that's that. So examiner says you calculate for each company. So for Michelin, I would then go to the question, what's the dividend of Michelin? Give it to me. What's the dividend of Michelin? Are we still together?
1080.
1080. 1080. Let me write it. Then what's the growth rate of Michelin? According to the question, we are told that why Michelin banks dividend 12%. So Michelin banks dividend are expected to grow by 12%. So 1.12. divided by dividend yield. Remember, I told you dividend yield is the same thing as cost of equity. So according to the question, we are told that if you look at the last paragraph before the requirements, you are told that the dividends of both companies have been paid. The required rate of return of the ordinary shareholders of Michelin Bank PLC is 15%. So cost of equity of Michelin Bank is 15%. So here is 0.15 minus growth rate of 12%, 0.12. So equal to, I would then say 1080 multiplied by 1.12 equal divided by 0.03 equal, that's 4030. 4320 million. Figures are in million according to the question. So that is that. That's the market value of Michelin. I will do the same thing for Dunlop. According to the question, the dividend of Dunlop is 11.55. 11.55 multiplied by the growth rate of Dunlop. Dunlop are expected to grow by 4% per
4%.
annum. Thank you. So that will be 1.04. What's the cost of equity of Dunlop?
12%.
12%. Okay. Minus 0.04. All right. What is the 12? What is the 12%? The dividend of both companies have been paid. Cost of equity. Yeah, Dunlop is 12%. Correct. Confirm. So this then will be equal to 1155 multiplied by 1.04 equal divided by 0.08 equal 15,015. Here is 15,015 million. So that's the market value of Dunlop as well as Michelin. So we have answered the first requirement in C part of the question. Then C high of the question. Examiner is asking you, okay, you are asked to determine maximum price. Michelin Bank PLC will pay Dunlop Bank PLC. So let me put it down for you. Maximum price. So the maximum price to pay, the maximum price to pay represents the difference between the post merger value and the pre-merger value of the targeting company, that is the predator. So Michelin Bank is the predator. So how do you then calculate the maximum price to pay? So this will be calculated as follows. Now, we said that maximum price to pay is the difference between the post-merger value and the pre-merger value of the targeting company. So what this simply means is that we need to go ahead and calculate the post-merger market value. So I would then say calculating post-merger market value. So what is the market value after the merger of Michelin and then Dunlop? So I would I need to check information given after the merger. When you look at the last paragraph of the question, you are told that after the merger, that is in 1 year's time, Tire Bank PLC will retain 60% of its earnings, and post-merger dividend growth rate is expected to be 20%. So I've seen information I'm looking for.
10%.
Yes, so I've seen the information I'm looking for. So examiner has told you that after the merger, then the post-merger earnings, the Tire Bank PLC will retain 60% of its earnings. So if 60% of the total earnings is retained, that means they are paying out 40% as the dividend. Therefore, I would then say figures in million. So earnings. So first thing first, I need to determine the post-merger earnings. So the combined earnings of the two businesses. So I will pick earnings of Michelin Bank. How much is earnings of Michelin from the income statement, from the balance sheets? We are given profit, from the P&L. We are given profit after tax of 3240, 1540. So here is
3240.
32, 40, for please bear with me. Okay, so since Tire Bank will retain 60% of its earnings, that means they are going to pay out 40% as dividend. Therefore, I would then say post-merger dividend will then be equal to 40% of the combined earnings of 4780 equal to, so 4780 multiplied by 0.4, that's 1912. Okay, that's it. Then I need the post-merger cost of equity, dividend yield. Okay, According to the question, we are told that after the merger, the cost of equity will alter to 14%. So here is 14%. I also need post-merger growth rates. So according to the question, we are told that post-merger dividend growth rate is expected to be 10%. So here is 10%. So these are all the variables that I need to calculate the post-merger market value. Therefore, post-merger market value will then be equal to post-merger dividend of 1912 multiplied by post-merger growth rate of 10%, that's 1.10, divided by post-merger cost of equity, which is 14%, 0.14, minus the growth rate of 10%. So this will give us, okay, 1912 multiplied by 1.1 equal, divided by 0.04 equal 52,580. 52,580. This is 52,580 million. Okay, that's the post-merger market value. Therefore, maximum price to pay. Maximum price will then be equal to the difference between the post-merger market value, okay, difference between the post-merger market value of 52,580 and the pre-merger market value. Pre-merger market value of Michelin, because Michelin is the predator, is a targeting company. 52,580. Okay, so the value of Michelin is
4320.
4320. 4320. So the difference, this will be 12, this will be 260. Okay, so that represents the maximum price. Therefore, I would then say the maximum price that Michelin Bank PLC we pay to Dunlop Bank PLC is 12 billion 260 million naira. 12 billion 260 million naira. That's it. That's the end of the question. That's what the examiner is asking you to do. So let me know if you have any question on this, so that let's have one more illustration before we close the class. Okay then. So let's have one more illustration. Yes, let's have illustration number 2. This one has to do with asset-based as well as the income-based approach. Somebody should help us read. Who will help us to read the question? Gloria, are you there? Gloria. Okay. Bemi, can you help us to read the question?
Okay. The entire share capital of Wazobia Limited, an unlisted company, is held by the 3 directors of the company, Chief Oyemesi, Balogun, and Akogo. They have decided to sell their shares in order to complete a divestment proposal agreed with management, and as such, wish to know the likely value of shares before approaching prospective buyers. Should they fail to get buyers for the shares, the company will go into liquidation. The following information is provided in respect of the company, the statement of financial position of Wazobia Limited as at 31st December 2011. Extract from the published statement of profit or loss and other comprehensive income for the last 3 years are as follows. It was discovered that inventories were overvalued at the end of 2008 by 600,000 naira. The directors have increased their remuneration in order to reduce the company's tax liability. A realistic charge for services rendered would be 1,875,000 naira. The equipment is old and it is in need for replacement. The annual depreciation based on current replacement cost is in the region of 3 million naira. C. Each of the directors expressed different opinions on the valuation method to be adopted. To Chief Oyemesi, it is most appropriate to value the shares on the basis of price over earnings ratio. For this purpose, he argues that earnings should be defined as the average reported profits for the last 3 years after making proper charges for depreciation and directors' remuneration and correcting the error made on inventories in 2008. In his own opinion, Balogun recommends breakup basis using liquidation values as provided by experts. Akogun, on the other hand, believes that dividend yield basis used with available data obtained from 2 similar but listed companies where he is a shareholder. The relevant data of the listed companies engage in similar line of business as Wazobia Limited are as follows. E. Figures obtained from experts for items appearing in the statement of financial position of Wazobia Limited as at 31st December 2011 are as stated below. You are required to A. Compute the value for the entire share capital of Wazobia Limited using 1. Price over earnings basis with earnings computed on the basis proposed by Chief Oyemesi. 2. Liquidation breakup basis. 3. Replacement value basis. And 4. Dividend yield basis. Note: assume you are making the valuation as at 31st December 2011. Ignore taxation and liquidation cost. Show all workings. B requirement says that identify any 2 limitations associated with each of the methods above.
Thank you very much, Bemi. Yes, that is the question. That's the question. So in the A part of the question, you have to compute the value of the business using price-earning ratio. So without wasting time, using price-earning ratio, the first thing first you need to do, you can see from the scenario in the question that Wazobia Limited is an unquoted company. It's a limited liability company. Therefore, Wazobia will not have price-earning ratio. So, and that's why examiner has given to you the price-earning ratio of a comparable quoted company, okay? Company 1 and Company 2 to be 5.4 for Company 1, 6.6 for Company 2. Okay, so that's what you are going to use to value the business because of time. So let's dive. Let me stop sharing this and move to the working note. Okay. Solution to Wazobia Limited. Number A requirements. Valuation using price-earning ratio. Okay. So using price-earning ratio, we said that the market value of the business will be equal to the price-earning ratio multiplied by earnings. So like I explained to you earlier today, using price-earning ratio, if you want to value an unquoted company, you are supposed to borrow the price-earning ratio of a comparable quoted company because an unlisted company does not have price-earning ratio. So if that is the case, I will then go to the question. I need to determine PE ratio. So the PE ratio given to us in the question for Company 1 and Company 2 is 5.4 and 5.6. Therefore, I would then say, let's call it adjusted earnings. We want to calculate adjusted earnings. Or before that, just say PE ratio will be equal to 5.4 plus 6.6. Find the average divided by 2. This is 12 divided by 2 equal to 6. So you cannot use the entire 6 to value Wazobia because Wazobia is an unlisted company. So the risk of Wazobia is higher than a quoted company. So you cannot use the same price-earning ratio of a quoted company for an unquoted company without an adjustment. Therefore, I would then say adjusted PE ratio will then be equal to 6 multiplied by, so like I said, it all depends on your level of perceived risk. So you are supposed to adjust downwardly between the ratio of 10 to 50. So just where the 15% is the risk associated with the with Wazobia. In that case, we are supposed to account for 85% of the P ratio of the
Where
quoted
do we get
company.
15%, please?
It's an assumption.
Okay.
So 6 multiplied by 0.85. 0.85. That's 5.1. So we are using a P ratio of 5.1. So it is not sufficient for you to just assume 15%. So you have to state your assumption. So I'll just say, note PE ratio of the comparable listed company listed company have been adjusted to 85%. The 15% reduction represents the perceived risk associated with Wazobia Limited. Okay, so that's that. So examiner will know your position, how you arrive at your number, because all the students cannot have the same calculation because our level of assumption and understanding differ. So if that is the case, I will then continue with my market value. I will then say market value equal to 5.1 multiplied by the earnings. In this case, I need to go and do workings for my earnings because examiner has given us in the question that there are so many shenanigans or window dressings that the management of Wazobia carried out for the purpose of avoiding the tax. So let's go and do working for that. Okay. Let me see if this one will be sufficient. Adjusted earnings. Okay. So we have 2009, 2010, 2011, then total figures are okay. Now I will go back to the question where you are given the scenarios. In the note B, from the question in note B, you will see extracts from the published statement of profit or loss and the comprehensive income for the last 3 years. So I need information on the profits. So you are expected to pick the profit for the year. So that's 3,250. Profits for the year. 3,250 followed by 36, then 4,175. Please, somebody should add up the numbers. What do you have? Are you still there with me?
11,025.
11,025. Thank you. So I will then go back to the question. I need to go and make adjustments based on the information given in the question. You are told that it was discovered that inventories were overvalued at the end of 2008 by 600,000. So you have done IS 8, accounting estimates. You know about retrospective and prospective adjustments. So in 2008, inventory were overvalued. You know, when you overvalue your inventory, it means that your expenses will increase. It will profit. Your expenses will increase, then your profit will reduce. So if you want to make that correction, you are going to make a prospective adjustments from the immediate year. After 2008 is 2009. So in 2009, you are going to recognize the amounts that was overvalued, which is 600,000. So I would then say inventory 600. Okay. Have increased their remuneration in order to reduce the company's tax liability. A realistic charge for services rendered would be 1,875,000. So the directors were supposed to charge directors' remuneration of 1,875,000, but they end up charging a higher value. Therefore, the difference that they have overcharged, then you need to return it. Okay, that difference, you need to return it. Okay, because if they did not overcharge the director's remuneration, they would have paid a higher tax. But because of that, they increase their director's remuneration. So let's find the difference. Directors remuneration. Let me use this one as an example. So they charged 2,500 in the first year instead of 1,875. So what's the difference? What's the difference? 25.
625.
625. 625. In 2010, they charged 2,900. 2,900 minus 1,875. That's 1025. Here is 1025. Then in 2011, they charged 3,000. 3,000 instead of 1,875. Excess of 1,125. So add it up. Plus 1025 plus 625 equal 2,775. Okay, that's the adjustments. The next one, the equipment is old and is in need of replacement. The annual depreciation based on the current replacement cost is in the region of 3,000. So they were supposed to charge depreciation of 3,000, so 3 million, but they end up charging a lower amount. So that's undercharged. Because you undercharge your depreciation, your profits will also be understated. Okay? So, sorry, your profit will be overstated. So in that case, you need to make adjustments. So, depreciation is 2,250 across all years. Therefore, I would then say depreciation, you undercharge depreciation. Instead of 3,000, they end up charging 2,250. So the difference, is it
750.
2,250? So the difference of 750 will be deducted. Okay. You are supposed to deduct it because you undercharge your depreciation, which increase your profits. So this is 2,250. So what other adjustments? I think that's all. So what we need to do now is to just, what I'm looking for is the total. I'm less concerned with other ones. So I need this total. So 2,275 plus 600 plus 11025 equal minus 2,250 equal 12,150. Here is 12,150. So that represents the total.
Excuse me, please.
Yes.
Sorry, I know that we don't have time. The inventory, when it's overvalued, it increases profit. That is for the closing stock.
It
That's what you're referring to.
did not increase profits. It reduced your profits. Your expenses has gone up, so your profits will be lower. When you increase your inventory, remember
Okay,
in your
the inventory
POL,
it increased, not the closing stock.
in your POL, The top line is your revenue. After revenue is your cost of sales, your direct cost. Your inventory is
Purchases
embedded in your
less.
cost of sales. So if your inventory increases, your gross profit will be lower. Do you get?
Yes. I'm looking at it as a closing stock, but it's okay based on the way you have explained it. I'm looking at it as a closing stock for that year, and that will increase the profit.
Okay. So for the 3 years, we need to determine average profit. We have profit for 2009, 2010, 2011, which make up the total of 12,150. So that 12,150, you divide it by 3 to get average profits. So this will give us divided by 3, that's 4050. Okay, so average profit is 4050. Now that we have the average, we have made adjustment for the we can then continue with the market value using price earning ratio. Here is 4050. Therefore, the total market value will then be equal to multiply by 5.1. That's 20 million 655. Is this 650? Yes, 655. So that's the value of the company. The value of Wazobia PSC using price earning ratio is 20,655,000. So that's that. Let's move on to the next one. Yeah. Number 2, you have to calculate the value of the entire share capital of Wazobia Limited using liquidation. Number 3, replacements. So I'm going to match together number 2 and 3 since they are the same thing as asset-based approach. So I would then say number 2 and 3. Valuation using the first one is a liquidation, breakup basis. Using liquidation and replacements basis. Okay. So in this case, instead of you to be having 2 different tables, so you are going to create only one. So all I need to do is to just say liquidation, then replacements. Figures in thousands. So I will then go to the question. From the balance sheets of Wazobia, you are given freehold under the non-current asset. Remember, when you want to value a business using asset-based approach, you are supposed to consider the total tangible assets minus total liability. So to get the total tangible assets from the balance sheet of Wazobia, we have freehold property at cost, 6,500. Where we under note E. Under note E, you are given information on the freehold property to be 15,000 and 15,000 for each of the replacement as well as the liquidation. So instead of you to use the book value, you are expected to use the replacement value or liquidation value. So I would then say freehold properties. Okay, 15,000. 15,000. That's it. I'll move to the next one. From the balance sheets of Wazobia, we also have equipment at a cost. Less depreciation is 15,600. Before I put down the 15,600, I will go and check from the question if I'm given replacement cost for the equipment. So we are given equipment to be 8,650, 5,400.
There's a replacement cost.
So I would then say equipment under liquidation is 5,400. Then under replacement is 8,650. Okay. The next item is from the balance sheets. We have current assets. Under current assets, we have inventories. So inventory, the book value of the inventory is 6,975. But we are given numbers for that. We are supposed to replace that with the replacement and liquidation costs. Okay, 8,000, then 4,350. Inventories. Um, 8,000 for liquidation, then 4,350 for replacement value. So the next one on the balance sheets, we also have accounts receivable. So we are not given value for account receivable under liquidation and replacement. Therefore, you are going to use the book value, which is 4,825. Account receivable. Is it 48? Yes, 4,825. 4,825. The next one, cash equivalents. So cash equivalents. That is bank. That's a 650. 650. So that's all. We have considered all the tangible. We have considered all the assets. So at this point, I will add up all of this. That will give me total assets. So 15,000 plus 54 plus 8,000 plus 4,825 plus 650 equal 33,875. That's the total asset for under liquidation. Then under replacements, 15,000 plus 8,650 plus 4,350 plus 4,825 plus 650. That's 33,475. 33,475. So all we need to do now is to deduct. Sorry. 33,475. So we need to deduct total liability. Total liabilities. And according to the question, the liabilities given to us is 4,150 minus 4,150 minus 4,150. So that will give us the net assets. So I would then say minus 4,150, 29,325. Okay. The other one, 33875 minus 4150.
29,725.
725. 29725. So I can then comment to say that the value of Wazobia Limited using number 2, according to the question, number 2 is liquidation basis. Using liquidation basis is 29,725,000 naira. Then number 3, using replacement basis is 29,325,000 naira. So that is that. The next one, number 4, dividend yield. Note that assume you are making the value, well, let's consider with that. So when we want to use the dividend yield, number 4, okay, valuation using dividend yield basis. So the market value using dividend yield will be computed as dividend. So we are not given growth rates. So dividend divided by dividend yield. Okay, which is equal to, according to the question, the value of dividend is 2250. Dividend is 2250 divided by dividend yield. We are not given the dividend yield of Wazobia, but we have been given a dividend. So just add up the dividend yield and find the average. So in that case, I would then say note, dividend yield is equal to, the first one is 9 plus 11, then divided by 2, which is equal to 20% divided by 2, 10%. Okay, that's 10%. Sorry, this is wrong. Okay, so which is 10%. That's the dividend yield. In that case, I would then say 0.10. This will give us 22,500,000. Let me confirm. 22.
It's correct, sir.
Oh, okay. Thank you. Yeah, so that's it. The value of Wazobia Limited using dividend yield is 22,500,000 naira. That's it. That's it. That's the end of the question. Yeah. So examiner is asking you in the B part to identify any two limitations associated with each of the methods. So that's not difficult thing to do. Each of the method ignores time value of money. Okay, that's one limitation. It also assumes that, let me see, yeah, almost 11 o'clock. All right, so let me know if you have any question for me. Some of you have disappeared, no problem. So in our next class, we have minimum of 4 illustrations that we are going to solve. So we still have a long way to go. All right. So let's call it a day. We are going to meet by the grace of God next week. I will see what I can do if possible, because there is no way we'll be able to complete 4 illustrations next week, Tuesday, within the 2.5 hours, because there are big illustrations. So I would look at my schedule if I can accommodate, if I can have a free period on Sunday evening, then we may likely meet on Sunday by the grace of God. If not, it's what it is. So yeah, let me know if you have any question for me before we close the class. Any question? In the absence of no further question, that's it. I will see you next time by the grace of God. Good night, everyone.
Night.